guys, welcome back to Ribbon Rock channel. So today what I'm going to do is I'm going to introduce an amazing book which is written by Mr. Dr. Nassim Taleb. He is a very famous option trader. He has been trading options and become like he was a hedge fund manager, and also he was like a PhD doctor in and given speech on Bloomberg TV television, and he was a very experienced option market maker. So he's an option expert and also a mathematician. He is also familiar with many languages. So basically he's very smart. So this book, the reason why I'm introducing this book is because this is a very intense book. I know a lot of people been hearing there is a book called Black Swan. There are 3 volumes of that book, which is written by Nassim Taleb also. But then, like Mr. Nassim Taleb, for him, that this book is, the Black Swan itself, it's not really intense, but the Black Swan actually explain how linear conception of risk in real world doesn't really stands out. But in this book, he explains all these complicated derivatives, and also for these options, and how do all these options and derivatives operating in the financial market. So this book provides a very intensive insights, and it also explains what happened to option volatility, and explains a lot of very important concepts. For example, Greeks, all these volatility change, these change in Greeks numbers, and etc. So the name of this book is called Dynamic Hedging, which is managing vanilla and exotic options. So my vanilla option is what we trade on daily basis. If you are a trader, if you're you have these interactive broker, or maybe you have think of swim, this kind of brokerage account, you can start trading all these standard options contract, and you can, most of them, they are vanilla options. They have European style options, they have American style options, and it has very different rule when you're exercise those options, which I will explain in future series of video. So it's not very difficult concept. It's not very difficult to understand, but in the future I will explain it a little bit. And exotic option, on the other hand, is not tradable in a normal exchange. You have to go to OTC, like over the counter exchange, to trade these kind of products. So it's a bit more authentic. It's a bit more fancy, and it has many different functions, which I've been writing about all these derivatives, and how you can apply those derivatives in the real world financial market. So in this book, Mr. Taleb explains a lot of stuff. So as you can see from the preface, he has done like more than 200,000 option transactions over 12 years, and studying about 70,000 risk management reports. So he's a very experienced trader. He understands the difficulty. He understands the risk itself is not nonlinear, and also it's very important for option sellers to understand how to hedge against the risk. So there's this concept of dynamic hedging. Okay, so it's like how you be able to identify the risk, but in the same time be able to hedge that kind of risk in the really dynamic and very complicated market. So I'm planning to make this series like at least 5 episodes. So this is going to be the first episode, and then I will give you guys more of a bit of my study notes of how I'm reading this book, and at the same time forcing me to really know more of this book, and hopefully I'll be able to get some of the meaningful discussion with a lot of a very experienced trader from other channel as well, so we can begin discuss of these very complicated techniques of dynamic hedging in the universe of option trading. So basically, the very definition of dynamic hedging is that you have to look at, when you're selling options, you're very kind of afraid of, gamma risk. In the same time, you're afraid that, what happened with the underlying prices. And, sometimes it goes up, sometimes it goes down. As an option trader, when you're selling options, when you're selling volatility, you don't really want this kind of, super intensive or maybe like, a one-sided kind of heavy market momentum, because that is going to be really harmful for your option exposure. So what happened is you try to hedge the delta. You try to make delta as as neutral as possible, so you won't be exposed by any directional risk. That means as an option seller, you can start making money and wait till these option goals expire, and in the same time you collect all these time value. So you, in a sense, you're operating as an insurance salesman, right? How insurance company been operating is basically like they sell options, they sell insurance. As long as you get, as long as you're not hidden by a car or any vehicle, you'll be paying stable cash flow to the insurance seller or maybe insurance company, and they are making a lot of money by selling these insurance products. They are basically making a lot of in traditional term they call this floating, right? So when you're running an insurance company, there are a lot of people not being hit by a truck or not being like hijacked or by terrorists or whatever, so they're perfectly fine, but they are still paying their insurance fee. So this kind of money will be living inside of your bank as floating. You can make, you can basically invest this money, or you can lend this money, and in exchange of certain like profits, you're basically lending this money with certain interest rate. You're basically operating like a bank. So imagine option seller, basically like they are operating just like in financial institutions. They are operating like an insurance company. They are selling volatility. So as I've been saying, like all these concepts, I will go through all these concepts in future videos, so you'll be able to understand more intensively of what option trading is really about. And from my opinion, like option trading is going to be the next, like the future, big trends. Everyone's going to trade options because look at the liquidity of options; it's very huge. So in this book, there are very so many different concepts, P&L and all these VAF. I'm sure a lot of you don't really necessarily have a financial background, but I'm going to use a lot like friendlier kind of language to trying to help you understand all these difficult concepts and all these difficult definition and what they actually really mean when applied in a real trading universe. How does all these volatility, all these Greek will be reacting to certain market events. So today I think this is the content of today's video. So I hope you guys enjoy the content, and next episode we'll go through chapter 1, which is part 1. We'll be understanding a little bit of markets, instruments, and also people, different roles in the market sector. Sometimes you have option market makers, sometimes you have insurance sellers, sometimes you have option like hedgers, sometimes you have speculators. So there are different contents in this chapter, and the function of this video is not giving you tons of information that you cannot absorb. Is that I'm trying to break all these very difficult concepts into something, that's very easy to understand. So you won't be wasting a lot of time trying to understand those formula. Okay? So thank you guys for watching. I'll see you in the next episode. Goodbye.